I want to welcome you all, and I'm happy to have you here. We had a few webinars in the past talking about blended finance, and as you know, I am researching a little bit about blended finance. But I think the bigger picture and what we want to talk today, and what the aim of these webinars is we mentioned several times that there is a 2.5 trillion annual gap in funding for the SDGs and actually Sustainable Development Goals. And this is actually putting really or threatening that we might not be able to achieve them by 2030. So the role of private capital is really crucial to close this gap and actually to address the most pressing issues that are actually what the SDGs represent. The Sustainable Development Goals really represent this common framework with very specific targets. And the interesting side of that is these targets are also financial targets that we can achieve. And again, the role of the private sector is been shown as a key player. But why do you think, or why is the private sector many times falling short of participating in these kinds of projects or bringing solutions to market? No, and there are many reasons, but among them, and some of the ones that we are researching at the ELEA Center with Patrick Reichhardt, might be in the way we make decisions about asset allocations or financial resources allocations. And in many cases, the equation between risk and return, and when we talk about impact investment, we add impact, risk, return, impact, in many cases can be problematic. So if you had to choose between a project with positive social and environmental impact and a project without social and environmental impact, obviously the decision is very obvious. Most of us are well-meaning people, and we will decide and go for the positive impact. But what happens when the risk is extremely high? Or what happens when the returns might not be market returns or might be below market returns? And many of the social environmental projects sometimes had these challenges. So I think the interesting part of blended capital and this idea of mobilizing additional capital that wouldn't otherwise be there for this investing is how can you de-risk these projects or these solutions, and how can you bring them up to market returns? So many of the collaborations and the blended finance promise is precisely addressing the way or the challenges in the way we were making decisions in the past. And again, one way of attracting private capital, can be blended finance. And I think that we have seen in the past the definition, if you want, of impact investing, and I have shown this slide like 2,000 times already, so I probably, you're a little bored about it. But when we talk about impact investor, we talked about somebody that actively places capital, so intentionally places capital to generate a measurable desired impact with positive social and environmental outcomes, and these have to be measurable. This is why we have the second block of measurable impact that would not have occurred without this investment. And this is kind of the idea of additionality. And when we talk about venture philanthropy, we talk about kind of concessionary returns, but we also talk about finance first type of impact investment, so above market returns and market returns. So the interesting part when we talk about blended finance is we don't expect only one actor or one type of impact investor to actually achieve all of this, but these results will actually come out from the collaboration of different players. So I find very interesting the definition that Convergence have. Ladé comes from Convergence, and we will introduce Convergence finance in a minute, but really defines blended finance as the use of catalytic capital from public or philanthropic sources to increase private sector investments in sustainable development. So we are trying to talk today, how can we bring different sources of public, philanthropic, and private capital to confront the grand challenges that we're facing today. And I'm a strong believer that there are a lot of promising solutions that can accelerate and scale investment in impactful solutions and social innovation. That is what the Lea Center is all about when we talk about collaborating through blended finance solutions. And something else that I think is kind of nascent right now is the role of corporates in these kinds of solutions. So there are not many examples, but you have seen already, we talked to BNP Paribas and Michelin in one of the webinars, and with the Jacob Foundation and the cocoa industry and a lot of corporate players. But I think also that corporate players can play a very interesting role in blended finance solutions. And just to finish up with the theory part again, and this is coming from Convergence, the key characteristics, especially on these blended finance solutions, and I think that we talked about the return, that to have an overall financial return, risk return for private investors in line with the market. Also, this idea of impact, it has to contribute to SDGs, developing countries, and today we're going to talk specifically about Africa and Sub-Saharan Africa. You know that I try to face the different regions so we understand the common thread, but also the specificities. But the last part that I think is very interesting is this idea of leverage. How can you leverage public and philanthropic capital to become catalytic? So before, we had all the players trying to act directly. You had the public sector directly investing in projects. You have philanthropists directly investing in projects, and we all were having marginal changes. And sometimes the private sector, or more traditional, conventional private sector, staying, or even if you want institutional investors that we'll talk today, shying away from this type of solutions. So the idea is, how can we make them collaborate? How can we create financial tools that they're comfortable with and that reach market in line with market returns, but also have a role and a de-risking role for public and philanthropic capital? So I think we are in for a treat today with lots of examples and great experience from Convergence that is actually leading this field, I would say, on work with very innovative solutions. And just house cleaning as usual, many of you already know, but the idea is to have a very participative webinar, because I think you may have lots of questions, and Ladé and Irene, we have two great guests today, will answer to you. So please use the Q&A. Don't use the chat for the questions. The chat we use to talk informally, but in the Q&A, write the questions that you want for the speakers. I will be managing that. If somebody writes a question that you really like, please click on like, that sign of the like, because that will make that question to pop up for me. So I will see it a lot higher if it has many likes, and I can ask our speakers about those questions. So without more introduction or on theoretical topics, I want to say first thank you to Ladé Araba for being here. She's the managing director for Africa at Convergence Blended Finance, as I mentioned, and she really has a pretty impressive CV. That I will share a little bit with you. She's a senior developed finance executive. She's been for the last 17 years, and she's been managing the Africa part of Convergent Finance. And she previously served as a technical advisor to the former Minister of Finance of Nigeria, and she was the head of the Strategic Monitoring Unit. She was also an advisor for power sector team at Nigeria Infrastructure Advisory Facility. And prior to that, she also was a technical advisor to the Executive Secretary of the United Nations Economic Commission from Africa. So, and she really worked on building the blocks for financing regional infrastructure projects and promoting intra-African trade. So as you know, I like people that have many different sides of the experience, and I think you see in her background how she has developed in many different corners of structuring these kinds of deals. So, and she also was a senior investment officer at the African Development Bank, where she played key roles in deal origination, appraisal, and approval of infrastructure projects across Africa. And she managed in total of an excess of $2 billion in projects. Now she holds a master, an MBA from Thunderbird, and a dual bachelor in business administration degree and a management information systems, and from the University of Oklahoma. So we also have Irene Gathiaca here with us, and I will introduce her appropriately a little bit later, because she's going to talk later about one of the examples and the project, very exciting project, but I will introduce her a little bit later. So thank you very much, Ladé and Irene, for being here with us. And I just want to ask you maybe to kick off this conversation. Can you tell us a little bit more about Convergence and what does it mean to work in a place that actually has as a core business this idea of blended finance? What do you do at Convergence?
Thank you so much, Vanina. It's an absolute pleasure to be here with you this morning, and good morning, good afternoon to all the participants, wherever you're dialing in from. I'm really excited to speak about blended finance, the global market, opportunities for institutional investors, but also more specifically, what's happening within sub-Saharan Africa. Convergence, as Vanina mentioned, is the global network for blended finance. We generate proprietary data, market intelligence, as well as deal flow, with the ultimate objective of pulling in private investment at scale towards SDG-related transactions in emerging and frontier markets. This global network brings together every type of capital provider that exists. So you'll find that in our membership, we have donors, NDBs, DFIs, foundations, but we also have commercial banks, private equity firms, institutional investors, broadly speaking, they're asset managers, and we allow them to identify co-investment opportunities. We give them access to deal flow, and we also provide access to the largest database of closed transactions. And finally, Convergence itself provides grants for early stage innovative blended finance vehicles that have the potential for scale and replication. So effectively, we're working to build the entire field of blended finance. And we can move on to the next slide. Now, Vanina gave our definition of blended finance, which is really just leveraging concessional capital to improve the risk return profile of transactions so that they appeal to private investors. Now, what does that mean in practice? There are many different ways in which you can structure deals, and typically we lump them into archetypes. And Convergence has observed from our data that there are 4 primary archetypes that tend to show up quite frequently in blended finance transactions. And before I explain each of these 4 archetypes, I also want to clarify that it's very rare to find just one archetype at play. Typically, transactions will be structured with 2 or 3, sometimes all 4 archetypes, depending on the specific transactional risks that underpin the specific deal that you're looking at, or if there are other market failures that might undermine the performance of the transaction. So the first archetype that we tend to see quite frequently is where concessional capital is basically applied within the capital stack as either sub-debt or junior equity, providing a first loss layer of protection. And we see this across most transactions. A second archetype is where there's credit enhancement. Credit enhancement could be in the form of guarantees. So if you're thinking about a wrap for a bond issuance, an infrastructure project, or even insurance products that are basically provided, to protect investors in the event of, an extraordinary event. A third archetype is where there is a commercial structure that has a parallel technical assistance facility that is often grant funded, and that technical assistance can be deployed for capacity building or to address other market failures, which again might place the transaction at risk. And we see technical assistance being applied before during, and also after investment. And then the fourth most common blended archetype is where pre-investment grant resources or technical assistance are utilized for project preparation and project development. We know that this is generally a very risky phase of a project life cycle, and it's very unlikely to find any investor who's willing to participate at that very early stage. So that's really where concessional capital can play a catalytic role. And we can move on to the next slide.
And I think I actually contacted you because I saw one of those grants for a piloting project that we will mention later. So how that plays an important role too.
Certainly. The other thing that I want to highlight is that blending can happen at various tiers of financial structuring. So you can have a project or a company that are blended. You can also have blending at the fund level. You can have blending at the fund of funds. You can have facilities that are blended. And you can also apply blended finance directly to financial intermediaries. So there's not just one way in which we see blended finance at play.
Let me interrupt you 2 seconds. Ivan is asking a question. What do you mean by technical assistance? So what kind of technical assistance can you finance?
So technical assistance, again, it's quite broad. I think we often think of technical assistance as capacity building. So whether it's you're investing in a company and that portfolio company maybe has a weak management or doesn't really understand basic bookkeeping, they don't have financial controls, you can provide technical assistance to help to build that capacity of the management team and to help them have a structure that works. Within the context of a project, technical assistance can also be utilized to support the structuring of the transaction and so on. So there are many different applications of technical assistance.
And I think we've seen in other webinars on venture philanthropy how sometimes $1 that you invest in a social entrepreneur, etc., sometimes you'd need even $2 on enterprise building if you want, in this, especially in very early stages on the value of death. So sometimes these grants can be really life-changing, and really create the pipeline to later scale up,
Absolutely.
And if we think about, we were talking about this, as I was just mentioning about the valley of death, that there are certain parts when in the enterprises, and the life cycle of enterprises with these philanthropic or sometimes below market returns are especially needed. Does blended finance happen only there? Or can this happen in any other parts of the life cycle of the project? We need it only for enterprise building, or can be already to speed a scale up? And again, it sometimes even more interesting for institutional investors.
That's a fantastic question, Vanina. So if we go to the next slide where I show the project life cycle, the beauty of blended finance is it is relevant across the entire life cycle. So blending can happen at a point in time, as you rightly mentioned, but it's also possible to have sculpted blending where the various types of capital come in at different points in time. So if you think about a traditional project, let's say an infrastructure project, a power plant, pre-investment, there are a number of technical studies, feasibility studies, building the financial model to ascertain whether or not this can become a bankable project, and carrying out that project preparation often requires a few $1 million. It takes time. It can also be quite risky. So that's really where we often see concessional capital in the form of grants, and again, TA, helping to develop the project. Once you get to construction, and there's a different phase within the project lifecycle, we start to see that concessional capital as well as sometimes impact investing will come to play, because that really helps to bridge the gap between the purely concessional and the purely commercial. And obviously, once the project is operating and is cash flow positive, it then becomes commercially viable. And so you'll notice that the level of concessional capital basically tapers off, and you start to really see commercial investment coming in. So this is one example where blending actually happens across the entire life cycle of the project. This slide is just really to highlight again that you can have various investors or funders participate in the same transaction, even if they have varying mandates, different risk appetites, and different objectives. So again, thinking about the capital continuum, here we're looking at, the purely concessional, so this is aid, philanthropy, purely grants, all the way through to the commercial investment where, the investor requires an attractive risk-adjusted return. Their risk appetite will be variable. Effectively, all of them can participate in the same deal and all of them can achieve their objectives. And the beauty of it is you're also contributing towards development without necessarily requiring every investor to have that objective.
I know, and I think that's part of what I find extremely interesting about blended finance is how can you break the silos and have different mindsets collaborating and bring it to the table their own assets, and finding this financial tool, I would say, that becomes the common language along with ImFact. So there is really a lot of talk these days about blended finance. So, but is this a new concept? And what regions and sectors account for the most blended finance that you think? And specifically, obviously, we're interested in Africa in your presentation. But can you give us a little bit of a frame of what's happening?
Certainly. So even though blended finance is a concept that we've started to hear a lot more frequently in the last, I would say, 5 years in earnest, it's really not new. We have within our database of historical deals, about 560, we have transactions that date as far back as the late 1970s and early 1980s. But what we have observed is that blended finance really has two very important inflection points. So from about 2009, 2010, right after the global financial crisis, the Lehman Brothers collapse, was when we started to really see an uptick in the volume of financing flowing specifically to blended finance transactions. And, that's intuitive. A second inflection point has really been, from around 2015 with the adoption of the Sustainable Development Goals. So in aggregate, we've seen over $140 billion placed into blended transactions with participation from a variety of investors, over 1,200 of them, and they have made about 4,200 financial commitments to these various transactions. Moving on to the next slide, we can see that most activity to date has actually been in sub-Saharan Africa, representing over 40% of the global market. And I will show you further on, where in sub-Saharan Africa most of this activity has been taking place. If we move on, I just want to quickly touch on the sectors. So we have consistently seen that the energy, this includes, utility scale, power generation, transmission, distribution, as well as off-grid solutions, including microgrids, solar home systems, has been the sector with the most number of deals that have closed, as well as financial services, which includes microfinance, access to finance for SMEs, and other types of financial sector deepening. It's very intuitive for us to see a lot of activity in energy and financial services because those tend to be quite commercial in nature, and it's quite easy to recognize the revenue line. We're also starting to see an increase in other sectors like agriculture, other infrastructure subsectors, and certainly with this global pandemic, I think the realization that we need to blend more in social sectors like health and education is going to become a lot more apparent. Moving on to the next slide, we can also see that a variety of different funders and investors have been involved in blended finance. Again, this comes from Convergence's historical deals database, and we basically create these league tables across the different segments to see who the most active players are. So we've seen a lot of activity from the US government through USAID, IFC, the private sector arm of the World Bank, the Gates Foundation, a lot of activity in healthcare and agriculture. And on the private side, we see a lot of activity from Standard Chartered Bank in infrastructure projects, and also Calvert Impact, which considers itself to be an impact investor. Moving on.
We have two questions. Will is asking, are the transactions typically driven by catalytic first loss provider or by others, perhaps commercial interest in mind? And is it possible to bring large-scale institutional capital into this market? And I know you have a position on that. Yeah.
So I'll answer the second question first. Absolutely. And, we are going to run through, time permitting, a few transactions where we have had institutional investors place large volumes of capital into larger size deals. And thankfully, we have Irene from ImFact, who's going to talk about, one of the innovative vehicles. The first question, from my earlier slide, most of the transactions do have concessional capital with that first loss layer of protection. So you're absolutely right. Although, as I mentioned as well, they tend to also be structured with other blended archetypes.
Yeah, and we have Marco. I know you're not a specialist on Latin America, but the generic question can apply anyway. Could you share your views on blended finance on highly sanctioned countries like Cuba? So if you have countries with this political risk, if you want, have you seen this kind of blended finance solutions?
So we generally don't either facilitate or really look at, countries with those types of extreme sanctions and, political situations, just because it's not quite within our mandate. So there's probably potential, but the restrictions that having these types of sanctions plays on investors. So I think it's just really difficult to apply blended finance. It's not a silver bullet. So I think those are some of the types of risks that are really difficult to overcome.
Great, thank you. So if we are, I mentioned, I think, kind of a lot of these issues on putting different players together. But in your experience, what is the key rationale behind blended finance solutions, and why it is relevant to all these players that you just shown that are participating in this field?
That's another excellent question, Vanina. So effectively, it's the same types of risks that any investor would appraise when they are thinking about placing capital into any transaction. So you're looking at market conditions, volatility. Investors like certainty. Volatility does not, contribute towards certainty. Political risks, regulatory risk. There's also, the credit risk within the market. We find that in emerging and frontier markets as well, there's low levels of liquidity, which obviously is a big consideration for investors. We also know that investors wanting to gain exposure in nascent sectors or other jurisdictions that they're not familiar with really suffer from an information asymmetry. So they don't really understand the local context. And oftentimes we hear that the risk perception is higher than, the actual risk on ground. So that's one of the issues that investors have to deal with. We also know that ticket sizes matter. So the question earlier about institutional investors, they're not going to get out of bed for a $10 million deal. And we do know that in emerging and frontier markets, deal sizes, especially even within Africa, deal sizes do tend to be smaller. So that does prevent some investors from participating. And of course, the investment climate can be quite tricky. So what blended finance is trying to do, if we look at the next slide, is to create...
I interrupted 2 seconds before we decide because we have quite a few questions. And Elko precisely asked about ticket size. So what is the median ticket size that you're working? And do you advise people who only need, or do you advise people who only need 1 million, for example?
So I will actually talk about ticket sizes when I look at the trends in Africa. So I would ask if you can pull off on that one in particular. So basically, if you think about it from that perspective, generally, if you're evaluating or thinking about investing in an emerging and frontier market, you find that the scale is often tipped towards the risks. And so this does not become an attractive investment proposition for an investor. So the next slide shows that what blended finance is trying to do is then to balance the risk return profile so that you have transactions that are commensurate with the appetite of the investors and also what they would be able to obtain in a developed market. The next slide really—
I have a provocative question from Raymond here. So precisely on this side of the story, who carries the highest risk in blended finance? And what are the most frequent reasons? And this is the provocative side of the story, why blended finance projects end up in difficulties.
So move on to the next slide. So I wouldn't necessarily say the blended finance transactions specifically end up in trouble. I think that if you have a well-structured deal, then its probability of success is a lot higher. So any transaction that runs into trouble, it's not because it's blended, it's because probably it wasn't well structured, or they didn't really factor in all of the risk sources within the structure. So if you think about, look at the graph to the right of the screen. The blue line, the M line, represents risk-free securities. So think about U.S. Treasury securities. The U.S. Treasury is considered to be a creditworthy issuer with a very low probability of default. No comment on the current.
Let's keep that one out.
But in general, that's the expectation. So if that blue line represents, the acceptable risk return profile for an investor, and the x-axis is the risk levels, while the y-axis represents the expected returns, you need to create transactions that ultimately fall anywhere on that line. Now, let's say there's a project in a developing country that falls at point C. That falls at point A. My graph is mislabeled. What that means is, it's a high risk project that does not meet the investor's risk return appetite. So what blended finance would do is either to de-risk by reallocating some of the transactional risks to a concessional capital provider, and therefore moving the transaction from point A to point B so that it's now on the blue market line, or without reducing the level of risk, it can increase the potential upside to the investor, so moving it from point A to point C. So it's back on the market line. So effectively, blended finance is either providing additional downside protection or an even more attractive upside to the investor if they're willing to absorb additional risk.
Right. And I think we're at a perfect time, because Ivan is asking what represents a properly structured deal, and if we can give an example. And I think I'm going to take the advantage of that question to invite Irene Gathiaca here with us. We have an additional guest speaker. So sorry, today my things are happening like crazy. I had to go down my mic, but so I will turn off my camera now for some seconds so Irene can turn off her camera. I will introduce a little more appropriately Irene, because we are going to share with you one of the examples that was one of the, precisely when I found on the news, I thought it was very interesting. And the name is ImFact, and it used to be at the grant level called Shift. If you look on the net, that it was actually awarded one of these grants that Ladé was talking about. No, and I really think it's a great example of an innovative blended finance transaction. So let me introduce you to Irene Gathiaca. She's the head for East Africa Total Impact Capital. Her work mainly focuses on origination, corporate and investment finance, and she previously have worked at Stanliv in Kenya. It's an asset management company of the Standard Bank Group with headquarters in South Africa as a corporate finance executive. In that role, Irene was responsible for reviewing the non-traditional investment opportunities, as well as being responsible for originating, advisory, and structure such a non-traditional deals. And previously, she held senior positions at Absa Bank, Nedbank, and McKinsey in South Africa. So welcome, Irene. And can you share with us a little bit because we get different questions about examples, and we go now into examples, what ImFact is, and share with us a little bit your experience structuring one of these deals.
Thank you, Vanina, and thank you, Ladé. Glad to be here to have this opportunity, and I'll get straight into it. And the idea of a little bit of a background is that the idea of Shift, or what we are now calling ImFact, is that our sponsor, who is Ambassador John Simon, worked for the Global Fund for Malaria and TB. You might have heard of that fund. And along the way, he came across limitation in how people got drugs onto many areas in Africa, many regions in Africa. And the reason was there wasn't a clear path as to how you could get consistent, affordable medicine on the ground. And so on investigating further, they found that financing for distributor companies, as with many other SME groups, is hard to come by. And when you get it from institutions like banks, they ask for collateral, they ask for title deeds, they ask for your home, they're just shy of asking for your firstborn son. So basically, it's very difficult for SMEs in the region, at least in the East Africa region that I'm looking at, for SMEs to get financing. And now that there is COVID, it's even harder because banks are literally just looking to manage the loans on their books. They're not extending loans as yet. We are hoping that that will change soon. And so with that, we had to think, how can we help distributors without burdening their balance sheets? And then we realized that there is not a whole lot being done to unlock value from the debtors that they already have in their books. This region is notorious for not paying within the expected time. You find even people or companies that could pay well in advance, or at least within the 30 or 60 days that they're supposed to, they drag it out to 3, 4, 5 months. And for a small business, that means that you have to have a credit line or some other source of capital to keep your business going. So the proposal here is that Total Impact Capital and its partners, Cardano Development, we buy those portfolios of receivables and advance a good chunk of the value of those receivables to the SMEs, and the rest is paid as and when the invoices get paid. What does that mean? That we take the whole portfolio. We don't look at one invoice. We take the whole portfolio of receivables. Obviously, there's some due diligence to be done, things like make sure that your invoice is not encumbered or hasn't been sold to any other person, that there is no discrepancy in what's on the invoice versus what goods were delivered. So all that has to, we have some ticks to put on the due diligence list. But once that's done, then you get the SMEs getting a big chunk of their debtors' value upfront from us, and then the rest they get as and when the invoice is paid. And the reason for that structure is that you don't have to ask for any collateral because you already own the invoices that haven't been paid. So you give 50% upfront, 60% upfront. The rest, which is about 40%, means that should there be any issue in collecting on those invoices, there is a buffer that protects you of the 40%. And when SMEs listen to this and get that they don't have to borrow anymore, burden their balance sheet, it's quite a welcome product. And so where Convergence comes in is that the goal for this product is to go to market and raise money from the market. And our target is, insurance companies, pensions, and we can't do that without de-risking the product and also proving concept, as well as scaling it up to a size where you can actually go to market with, a sizable deal. And so where Convergence comes in is that all the initial preparation work that was done that was done to enable us get to market or to where we are at this point, that money was provided by Convergence. The preparation of market assessment, the preparation of where exactly is the band of SMEs that you want to look at that have the most need, but can also be able to carry this product, in the sense that you have to have a good flow of a debtors portfolio so that we can bank on this. You don't need intermittent debtors portfolio. You have to have a business that that's ongoing from from January to December, and enough of a portfolio that says you can afford the 40% that we're looking at, which covers us as collateral because we don't ask for any more. And so that bit of it meant that you will get to market, you prove concept, and you will de-risk it. And given the time that will take before we can go to market to raise money in the market, you will have grown the portfolio to a size. So that's where really, without the contribution of Convergence, we might have had a harder time convincing the market that this is necessary. We now have people actually calling us, wanting either to buy out the product completely or looking for ways to invest, not just in debt, but in equity as well. So, which tells you that in this market, when you have that upfront call that you are not the one actually going to look for investors, they are looking for you, then it does say that you're doing something right. Yeah. Do I leave it there for now? And then maybe we see if we have some more questions.
Thank you so much, Irene. So I think you see why, when I think we talked about small tickets, and SMEs are the definitions many times of small tickets, and the risk of approaching it with large size capital or attracting private capital. And I this is why I found so interesting. And I think also when we talk about SMEs and the pharmaceuticals and medicines, you can understand that this can be also the value chain of large corporates. And we've seen during the COVID crisis how important resilient value chain is. And so I think it's an interesting solution to actually look at invoices as part of the collateral. And again, it can be called a social innovation, if you want, in a way that you look at this problem and how the market could address it. So can you, Ladé, please give us a couple of other examples, because I think we can learn a lot from the different examples with different financial structures that you have used or that you know in your experience that are interesting.
Certainly. So the next example that I'll share with you, and thank you again, Irene, for talking a little more about ImFact. The example that I want to talk about next is Acorn, which is basically the first green bond issued in Kenya in 2019, oversubscribed, listed on both the Nairobi Stock Exchange as well as the London Stock Exchange. It benefited from credit enhancement, a 50% guarantee provided by Garantco. Garantco is one of the PIDGE group of companies, which is basically funded by donors. And what this did was to improve the credit rating of the issuance, obviously, which is intuitive. It makes the transaction definitely a lot more attractive to investors, and they were able to attract institutional investors and other private investors. And basically, the proceeds will be utilized to provide affordable housing for students in Nairobi, Kenya. So quite an interesting transaction that can be scaled and replicated. The next example.
We had a question from Will, and I think since you're mentioning now credit agencies here, he's saying such a niche market, who determines the appropriate risk return, particularly without ratings? So are you seeing more a tendency to try to have these ratings, or when there are no ratings, how do you assess the risk return?
So when there are no ratings, it's really up to the investor to determine what they're comfortable with. You can't really dictate because they have their mandates, they have their fiduciary responsibilities and so on. So it's really up to the investor to determine what they feel comfortable with.
Great, thank you. So
The next transaction is a fund, which is another indirect way for investors to gain exposure to emerging markets and also to diversify into a number of different sectors. So the Emerging Africa Infrastructure Fund is actually both a blended finance transaction as well as an example of a public-private partnership. It received concessional capital, so first loss protection from donors, and it basically provides long-term debt and mezzanine financing to infrastructure projects across Africa. It has been, the fund vintage is 2002, so it's been running now for almost 20 years and has lent over $1.3 billion to about 64 projects across Africa. Very importantly, last year we saw Allianz, which is the largest insurance company, a German insurance company, place about $150 million into this fund, which I think is testament to their recognition of, first of all, the performance, the track record of the fund itself, but also the potential to participate in a blended transaction that ultimately gives them exposure to infrastructure projects across Africa without taking direct exposure to a single transaction. So this one is also quite an interesting deal. The third one.
Do you see, we have also Marco here that works on infrastructure projects and in a DFI, but do you see a little bit more on these institutional investors willing to pilot and go into these deep impact projects rather than maybe the low interest rates that are going in the world right now? Are you seeing more and more happening?
Certainly. So I think overall, low yield environments are definitely driving investors to look for alternatives to invest in, and certainly to also think about emerging and frontier markets. And as I mentioned, a global trend we've observed, which is also prevalent in Africa, is that many of them prefer to start out through funds. So they're not taking direct exposure to a single transaction, but also because funds are pools of capital, they also tend to be larger. So if you wanted to place, Allianz placed 150 million into EIF, it's a lot easier to do that through a fund structure. So there's definitely, appetite, and we are seeing an increased level of participation from institutional investors in these types of deals. The third example is also quite interesting. It's a facility that actually consists of 3 funds. So earlier I showed you the project lifecycle. Basically, one of the biggest challenges that investors have is that they can't find enough pipeline. So the challenge is always, there's 1 or 2 deals that we invest in, but then we really struggle to find that pipeline of bankable projects. So what this is trying to do is basically provide wholesale lifecycle financing to develop renewable energy projects. So from the development phase through to construction and finally operations. So the way it's structured is the development fund is purely funded by donors, and it provides, development loans and technical assistance. It's all in concessional terms to allow for, the development activities. The second fund provides equity for construction, and it has 3 tranches. So the first tranche is, the donor capital, again, with that first loss protection. You have a second tranche that includes, commercial banks and other types of investors. And then the third tranche is really where institutional capital comes in. So this gives, these senior investors, basically access again to a diversified portfolio of good quality infrastructure assets without taking direct exposure. And because of all the tranches that are included in this fund, they actually are more protected than if they were to just go into a direct investment themselves. The third fund is not yet operational, but effectively it is going to be 100% funded by institutional investors, and it is to provide debt, so once the projects are operational, cash flow positive, they can then go and refinance on purely commercial terms with participation from institutional investors. So again, this is quite an interesting way to participate in blended finance.
And I think I've seen more and more structured products now coming into blended finance. I think 2 of the webinars that we talked, especially the one with Pierre Rousseau and BNP Paribas and Michelin financing reforestation was also structured products. And we are seeing more on how you tailor to these different risk return tranches happening. But they're also quite sometimes difficult to structure on the transaction cost side. No, what do you see on this part of the transaction cost side? How do you work with the different players, and how do you manage that?
So if I look back at the example of Acorn, so it's a fixed income security that's also blended, but they received a partially repayable grant from the Technical Assistance Facility, which is another Pidge Group company, to help to cover some of those costs. So with the issuance, but also getting the green certification for the bond. So those are other ways in which you'll find concessional capital helping to cover those initial high upfront costs to structure these deals.
No, and I also think, as you show the players in the field, I think we passed a little bit the prototyping phase, and we have many repeated offenders that learn from the past, had the legal structures in place, and are starting to do more and more deals at the time. So since time is going crazy and it's almost 11:50, I would like to see what's coming. A little bit of your view of the future, specifically for Africa, but also what do you think are the tendencies in blended finance that we need to be aware of and pay attention to?
Certainly. So, as I showed on my earlier slide, over 40% of closed deals have actually been focused in Sub-Saharan Africa, with a good chunk actually focusing on East Africa. So Kenya has consistently been the region with the most number of deals. Overall, we've seen about $45 billion of capital placed into blended transactions, with over 570 investors. If we move on to the next slide, consistent with what we've observed, globally, again, a heavy concentration, over a third, into funds, because again, it's a good entry point to get your feet wet if you're new to emerging and frontier markets. Great way to diversify portfolios again and to spread that risk. We also see a lot of projects. So about a quarter of these investments have been projects, and then you have facilities, companies, bonds, notes, different deal sizes, but generally we've seen that most activity happens between the 10 to $100 million deal size. In Africa, the median deal size is around $53 million, whereas globally it's about 57 million. If we go to the next slide, I mentioned that Kenya is the country with the most number of deals, but deal sizes in Kenya are tiny. So Kenya has probably the smallest average deal size. And one of the reasons for that is we see a lot of activity from impact investors and foundations who are specifically investing in SMEs. So obviously, SMEs don't have the capacity to absorb large volumes of capital, so it makes sense that we have a lot of deals, but they tend to be a lot smaller. When you look at Zambia, interestingly enough, their median size, they account for about 73% of funds, and their median size is a lot larger. So they're looking at things like infrastructure, which do tend to be larger on average. Moving on to the next slide, we can also look at some of the trends around, the beneficiaries of these transactions. So we find that, again, a lot of entrepreneurs, and then when you think about the end beneficiaries, the positive is that most of them are bottom of the pyramid or base of the pyramid. So ultimately, these blended transactions are contributing to development in real terms. The next slide, again, looks at the trends, and I think we're going to see this continue. It's consistent with the global averages. So again, a lot of energy, but the global trend for energy was around 27%. In Africa, it's a bit higher at 30%. Financial services is also significant, but not as significant as with the global trend. We're starting to see generalist funds that are investing in multiple sectors. I think that's going to continue. Certainly, agriculture, healthcare, education, other infrastructure will also continue to rise as people understand how blended finance works. And as they see deals successfully close and be implemented, you can simply replicate, these transactions. The last slide is really just, to look at the SDGs in particular, since ultimately that is a major objective of blended finance. We see that partnerships obviously apply across the board. A lot of activity is basically supporting industry and innovation, as well as, decent work and really tackling poverty. But you can see that generally, the SDGs are relevant, but blended finance, again, is not a silver bullet for every single SDG. You can't commercialize peace. So we're not saying that you can use blended finance to achieve all of the SDGs. There's some where, it's quite clear and it makes sense, but generally we have seen that blended finance has contributed across the board. And
Elko is asking a last question, and then we can do some closing, but I know you're a specialist on Africa, but he's asking if Convergence also works in Europe or you just work on developing countries.
So we are a global firm. We are headquartered in Toronto, Canada. We have a presence in Washington, D.C. in the U.S. Our Africa office is in Nairobi, Kenya. We also have an office in Manila, Philippines, serving the Asian market. And hopefully in the near future, we'll also have a presence in Latin America, serving that region in the Caribbean. So we are global. We have an MD for Europe who used to spend a lot of time in Europe, but now with COVID is unable to travel. So we work across, different regions and sectors, but the transactions specifically that we facilitate and that we look at are in developing countries. But if you look at our membership, everybody is represented. So we have European members and we provide services to them as well.
So thank you so much, Ladé. Thank you so much, Irene. And thanks everybody for your participation. I think as a little bit of closing words, I think what I find the interesting part of blended finance and is that how can you put together a coalition or a collaboration of different players around financial instruments that investors are comfortable with, to be applied actually to the most challenging and pressing problems, environmental and social problems of today, as represented by the Sustainable Development Goals that you mentioned. Now, how can we align the different incentives? How can we include into the equation this idea of impact without separating from the more traditional financial and economic part of the decision making? So thank you for Ladé for the great examples. I hope they have inspired you, and I hope I see you soon, because we in our next webinars we will be talking about more of these great examples. And thanks so much, and we will post the recording and a summary, but for slides, because we had a question from a couple of people, you have to contact the speaker for later sharing. So thank you, everybody, and stay in touch.
Thank you so much, Vanina. Thank you, everyone. Bye.